Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. Today we will be talking about General Mills. General Mills manufactures and markets branded consumer foods worldwide. In this video, we'll review the company's business by going over its annual report, then review the company's fundamentals by focusing on its key ratios, and finally find the intrinsic value of the company. So let's dive in and review General Mills.
Hey guys, let's start off by looking at the Form 10-K, which is the annual report that General Mills filed with the SEC. This is for the fiscal year that ended in 2021, and on page 4 of this report, the company provides us a business overview. The company states that it is a leading global manufacturer and marketer of branded consumer foods sold through retail stores. It is also a leading supplier of branded and unbranded food products to the North American food services and commercial baking industries. General Mills manufactures its products in 13 countries and markets them in more than 100 countries. In addition to its consolidated operations, it has 50% interest in 2 strategic joint ventures that manufacture and market food products sold in more than 120 countries worldwide. After that, the company outlines its 5 operating segments, which are North America Retail, Convenience Stores and Food Service, Europe and Australia, Asia and Latin America, and Pet. After that, the company states that its business is focused on the following large global categories: snacks including grain, fruit, and savory snacks, nutrition bars and frozen hot snacks, ready-to-eat cereal, convenient meals, yogurt, wholesome natural pet food, super premium ice cream, baking mixes and ingredients, and finally, refrigerated and frozen dough. Next, the company talks about a couple of its ventures for its ready-to-eat cereal category and its super premium ice cream category. As far as customers go, its primary customers are grocery stores, mass merchandisers, membership stores, national food chains, drug, dollar, and discount chains, e-commerce retailers, and so forth. During fiscal 2021, Walmart Inc. and its affiliates, also known as Walmart, accounted for 20% of its consolidated net sales and 29% of its net sales of its North American retail segment. No other customer accounted for 10% or more of its consolidated net sales. So it goes to show that Walmart is General Mills' largest customer. After that, General Mills talks about its competition. It claims that the packaged and pet foods categories are highly competitive, and in most product categories, it competes not only with other widely advertised branded products, but also with regional brands and with generic and private label products that are generally sold at a lower price. Internationally, it competes with both multinational and local manufacturers, and each country includes a unique group of competitors. Now let's go to page 88 of this report to get a better understanding of the company's reportable segments and the revenue breakdown across those segments. We can see that for the fiscal year 2021, the North American retail segment brought in about $11 billion. The Europe segment brought in about $1.98 billion. The convenience store segment brought in about $1.7 billion. Pet brought in about $1.7 billion. And Asia and Latin America brought in about $1.7 billion. Overall, the consolidated total revenue amounted to about $18.1 billion. We can see that the North America retail segment brings in the most amount of money for the company. And when we compare this total net sales numbers over the past 2 years, we can see that the company's total sales numbers have been growing. Next is the operating profit, which is what we get when we subtract the cost of goods and operating expenses from the sales numbers. For the fiscal year 2021, the North American retail's operating profit was about $2.6 billion. Europe and Australia's operating profit was $151 million. Convenience stores had an operating profit of about $306 million. Pet's operating profit was $415 million. Asia and Latin America had a profit of about $85.6 million. The overall total segment operating profit amounted to about $3.6 billion. When we compare North America Retail's operating profit to its sales number, we can see that the operating profit for that segment was about 23.85%. Similarly, Europe and Australia has an operating margin of about 7.6%. Convenience stores and food services has an operating margin of about 17.6%. Pet segment has an operating margin of about 23.9%. Asia and Latin America has a profit margin of about 5.11%. Overall, when we compare the company's total segment operating profit to its total net sales number, the company's operating margin comes out to about 19.75%. What this means is every $100 that the company makes in sales, by the time it pays for its cost of goods and operating expenses, it has $19.75 left. When we subtract some of these other expenses, the company's operating profit comes out to about $3.1 billion, which, when we compare that number to the previous 2 years, tells us that the company's operating profit has also been growing, similar to the company's net sales numbers. Now let's look at the net sales for its North America retail segment based on the categories. For the fiscal year 2021, the US meals and baking brought in about $4.6 billion. US cereal brought in about $2.5 billion. US snacks brought in about $2 billion. Canada brought in about $953 million. And US yogurt and others brought in about $927 million. Overall, the company's total net sales for the North America retail operations amounted to about $10.995 billion. When we compare the operating unit sales for the year 2021 to the year 2020, we can see that all the operating segments saw a growth in their numbers except the US snacks segment. Next is the net sales by class of similar product. For the fiscal year 2021, snacks was the biggest segment that brought in the most revenue at about $3.6 billion. The other notable products were convenient meals, cereal, yogurt, dough, pet, baking mixes and ingredients, super premium ice cream, vegetable, and others. Now let's look at the sales numbers based on the geography. For the fiscal year 2021, about $13.5 billion out of the total $18.1 billion of sales came from the United States. In other words, about 74% of the company's revenue comes from the United States. Now that we have a brief understanding of General Mills' business, its operating segments, and the revenue breakdown across those segments, let's review the company's fundamentals by focusing on its key ratios. Hey guys, I'm on Morningstar looking at General Mills. Under key ratios, we have the financials. The first item on the list is the revenue. The revenue is the top line of the income statement. This is the amount of money that the company brings in via sales. Back in 2012, the company's revenue was about $16.7 billion. And for the year 2021, it was about $18.1 billion. Over the past 10 years, the company's revenue has stayed fairly consistent. However, ever since 2017, the company's revenue has slowly been trending upwards. Next is the operating income. The operating income is the amount of money that's left with the company once we subtract the cost of goods and operating expenses from the company's revenue. Back in 2012, the company's operating income was about $2.7 billion. And for the year 2021, it was about $3.4 billion. Over the past 10 years, the company's operating income has stayed consistent. Next is the net income. The net income is the bottom line of the income statement. This is the amount of money that's left with the company once we subtract the cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes. Back in 2012, the company's net income was about $1.6 billion. And for the year 2021, it was about $2.3 billion. Over the past 10 years, the company's net income has always been positive, which tells us that the company has always reported a profit. Ideally, we want to see the company's net income, operating income, and revenue to have a similar trend. That is, we want these numbers to be positive, staying steady, or increasing. After that, looking at the dividends per share, back in 2012, the company paid out about $1.22 per share as dividend. For the year 2021, it was $2.02 per share, and for the trailing 12 months, it was $2.04 per share. Over the past 10 years, the company has consistently paid out dividends and has in fact hiked its dividends 7 out of the past 10 years. Next is the shares outstanding. Back in 2012, the company had about 667 million shares outstanding. Over the next few years, the company bought back some of its shares as the share count dropped down to a low of 586 million shares back in 2018. Over the next few years, the company's shares outstanding number grew to 619 million shares as of 2021. When a company issues more shares, it is likely because the company wants to raise money in order to finance its growth. Over the past 12 months, the company appeared to have bought back about 4 million shares as the share count is now at 615 million shares. Next is the book value per share. The book value is what we get when we subtract the company's total liabilities from its total assets. So essentially, the book value is the same thing as shareholders' equity. Back in 2013, the company's book value was $10.95 per share, and for the trailing 12 months, it was $16.29 per share. Over the past 10 years, the company's book value per share has always been positive, which tells us that the company always had more assets than liabilities on its balance sheet. Finally, looking at the free cash flow. The free cash flow is what we get when we subtract the company's capital spending from its operating cash flow. Back in 2012, the company's free cash flow was $1,726 million, and for the year 2021, it was $2,452 million. Over the past 10 years, the company's free cash flow has always been positive. Ideally, we want to see the company's free cash flow to be positive, staying steady, or increasing. I will be using the 2021 free cash flow of $2,452 million from my discounted free cash flow DCF analysis. Next is the profitability of the company, focusing on the net margin. The net margin is the ratio of the company's bottom line to its top line, so it compares the company's net income to its revenue. Back in 2012, the company's net margin was 9.41%, and for the trailing 12 months, it was 12.36%. What this means is every $100 that the company made over the past 12 months, by the time the company paid for its cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes, it had $12.36 left as pure profit. After that, looking at the return on equity The return on equity is the ratio of the company's income to its shareholders' equity. Warren Buffett prefers to only invest in securities that have a return on equity of 8% or greater every year for the past 10 years. Back in 2012, the company's return on equity was 24.51%, and for the trailing 12 months, it was 24.61%. Over the past 10 years, the company's return on equity has always been greater than 8%. The three ways that the company can generate high return on equity numbers is first, when the company buys back its shares, second, when the company becomes more leveraged, that is when it takes on more debt, and third is when its income numbers rise. Next is the return on invested capital. This number gives an idea of how good the management is at allocating the company's capital and getting a return on that investment. Back in 2012, the company's return on invested capital was about 13.33%, and for the trailing 12 months, it was 10.27%. General Mills' weighted average cost of capital, also known as the company's hurdle rate, is about 6%, and since the company's return on invested capital is greater than its weighted average cost of capital, we can safely say that the management is creating value for its shareholders. Finally, looking at the interest coverage. The interest coverage is the ratio of the company's income to its interest obligations. So it gives us an idea of how many times can the company pay off its interest using its income in that calendar year. Back in 2012, the company's interest coverage was 7.11 times, and for the year 2021, it was 7.68 times. Benjamin Graham, the father of value investing, preferred to only invest in securities that had an interest coverage of 5 times or higher. Now let's look at the financial health and liquidity ratios. The first item on the list is the current ratio. The current ratio compares the company's current assets to its current liabilities. Ideally, we want the company's current ratio to be greater than 1.0, as that tells us that the company has enough assets to fulfill its liabilities over the next 12 months. Back in 2012, the company's current ratio was at 0.96, and for the latest quarter, it's at 0.74. Next is the quick ratio. The quick ratio is similar to the current ratio except we disregard the inventory component. In other words, quick ratio is equal to current assets minus inventory divided by current liabilities. A quick ratio greater than 1.0 tells us that the company does not have to rely on selling its inventory in order to fulfill its current liabilities. Back in 2012, the company's quick ratio was at 0.51, and for the latest quarter, it's at 0.38. The company's quick ratio indicates that the company relies on selling its inventory in order to fulfill its current liabilities. The company's current and quick ratios are comparable to its competitors. After that, looking at the financial leverage. The financial leverage is the ratio of the company's total assets to its shareholders' equity. A financial leverage of 1.0 tells us that all of the company's assets are financed via its shareholders' equity. A financial leverage of 2.0 would tell us that half of the company's assets are financed via liabilities and half of them are financed via shareholders' equity. Back in 2012, the company's financial leverage was at 3.29, and for the latest quarter, it's at 3.17. Ideally, we want the company's financial leverage to be staying steady or decreasing. General Mills' financial leverage has been trending downwards ever since it got to a high of 5.04 back in 2017. Next is the debt to equity ratio. This ratio compares the company's total debt to its shareholders' equity. Ideally, we want the company's debt to equity ratio to be less than 1.0. Back in 2012, the company's debt to equity was at 0.96, and for the latest quarter, it's at 1.12. Over the past 10 years, the company's debt to equity ratio has fluctuated between a low of 0.89 to a high of 2.06. Now let's look at the efficiency ratios. The first item on the list is the days sales outstanding. This number gives us an idea of how many days go by from the day the company recognizes its sale to the date it actually receives cash for that service rendered. Back in 2012, the company's days sales outstanding was at 27.23 days, and for the trailing 12 months, it was 34.56 days. Over the past 10 years, the company's days sales outstanding number has stayed fairly consistent. Ideally, we want the company's days sales outstanding number to be staying steady or decreasing. What we do not want to see is a company whose days sales outstanding number is growing rapidly, as that tells us that the company's management is being aggressive with its accounting, as it's trying to recognize its revenue sooner so that it can inflate its income numbers on its income statement. General Mills' days sales outstanding number has fluctuated between 27 to 37 days range. Next is the days inventory. This number gives an idea of how many days does the company's product sit in its inventory before it's sold. Back in 2012, the company's days inventory was about 53 days, and for the trailing 12 months, it's about 51 days. Ideally, we want the company's days inventory number to be staying steady or decreasing. What we do not want to see is a company who has a growing days inventory number, as that tells us that the company's inventory is just lingering around on its balance sheet. We rather see that inventory be pushed onto the company's income statement and be realized as a profit. In the case of General Mills, the company's days inventory has stayed fairly consistent. It has been trending downwards ever since it got to a high of 55 days back in 2018. Finally, looking at the payables period, this number gives an idea of how many days does the company take to pay its suppliers. Ideally, we want the company's payables period to be staying steady or decreasing. What we do not want to see is a company whose payables period is growing rapidly, as that tells us that the company's management is trying to hold on to its cash in order to artificially inflate its cash flow numbers on its cash flow statement. Back in 2012, the company's payables period was about 37 days, and for the trailing 12 months, it's about 101 days. Over the past 10 years, the company's payables period has slowly been trending upwards. It is not growing at a rapid pace where it's a cause of concern, but this is certainly something to keep an eye on. Now let's look at the company's current valuation. The company's current market cap is $40.86 billion. The company's trailing PE is 18.09. The company's price to sales is at 2.24. The company's price to book is at 4.16. And finally, the company's enterprise value to revenue is at 2.81. An enterprise value is simply how much money would it take to buy out the whole company. It includes the company's market cap plus any debt that the company has. So an enterprise value to revenue just tells us that if we were to buy out the whole company, it would be at 2.81 times the company's top line number. Now let's look at General Mills' discounted free cash flow DCF analysis. Over here, I pasted the company's 2021 free cash flow number that I got from Morningstar, which was $2,452 million. I'm using an annual growth rate of free cash flow to be 6%. What this means is I expect the company's free cash flow to grow at 6% every year for the next 10 years. I'm using a discount rate of 10%. What this means is I want this investment to give me an annual return of 10%. In other words, I want to double my investment in about 7 years. I'm using an annual growth rate of free cash flow to be 3.39%. What this means is after the 10-year mark into perpetuity, I expect the company's free cash flow to grow at 3.39%. This number is in line with the 30-year US Treasury yield. The company has 615 million shares outstanding and has a long-term debt of $9,787 million. After taking all of these inputs into account, we get the company's intrinsic value to be about $58 per share. And when we compare this intrinsic value to the company's current stock price, which is about $67.85 per share, we can see that the company's current stock is trading about 1.16 times the company's intrinsic value. The way we calculate this intrinsic value is we look at what the free cash flows would be every year for the next 10 years. We sum up all those free cash flows, which come out to about $20 billion. Then we look at what the free cash flows would be after the 10-year mark into perpetuity. We add those up to get the intrinsic value to be about $45.6 billion. From this number, we subtract the long-term debt and divide by the shares outstanding to get the intrinsic value per share to be about $58. Now, if we disregard the perpetuity component, in other words, if you think that General Mills is only going to grow for the next 10 years and then it'll cease to exist, then we get the intrinsic value without the perpetuity to be about $17 per share. And if we disregard the debt, in other words, if you think that General Mills is going to grow into perpetuity, so there's no point for us to worry about the company paying off its debt, then we get the intrinsic value without the debt to be about $74 per share. Finally, let's try to figure out what kind of return can we expect to get on this investment if we were to invest in the security at the current stock price. For that, I will run a goal-seek analysis where I will set my sell to the intrinsic value. My to value will be the current stock price, and I will run this analysis by changing the company's discount rate. What I get is if I were to invest in the security at the current stock price of $67.85 per share, I can expect to get an annual return of about 9.29% on this investment. Overall, General Mills has good fundamentals. Its revenue and net income numbers have been predictable and stable over the past 10 years. However, for the foreseeable future, the inflationary pressures on the cost side of the business will put pressure on the company's net income numbers. General Mills continues to revamp its business, and the management is prioritizing core markets and brands with best prospects for growth. Recently, the company has made key acquisitions in the pet foods category, which offers more growth potential than some of its more mature cereal and snacks category. Hey guys, that is all I had for you this week. Hopefully you found this video on General Mills interesting. If you like this content, please do like, share, comment, and subscribe. And if you have any suggestions on which stock I should review next, please leave it in the comment section below. I'll greatly appreciate it. Thank you.